You've set up your Trading 212 Pi, it's going well, you decide to put some more money into it. You're then asked this question of how you want your deposit to be allocated. Worried about getting it wrong? Well, no need to worry. In this video I'll explain each of the options listed here and which you should go for depending on your situation. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. Remember, your capital is at risk when investing. So there are three options here: self-balancing, buy targets, and custom. Let's explain each of them one by one. First, self-balancing. The self-balancing option ensures your money is allocated in a way that corrects any imbalances in your portfolio. Over time, certain investments in your portfolio may grow faster than others, leaving some underrepresented and others overrepresented compared to your original plan. Selecting self-balancing steps in to attempt to fix this. It allocates more money to the underweight investments, those that are below their target percentage, and less to overweight investments, those above their target percentage, gradually restoring the balance. Over time, those slices may grow larger because they performed well, while others shrink due to weaker performance. Self-balancing takes new deposits and adds more to the smaller slices to bring them closer to your intended size, ensuring your portfolio remains aligned with your goals. This option is an automatic way to maintain your portfolio without the need for constant monitoring. For example, let's say your target allocation is 50% Apple and 50% Coca-Cola. That's not a financial recommendation for Pi allocation, by the way, obviously I hope. After a report on iPhone sales, your portfolio shifts to almost 60% Apple and 40% Coca-Cola. Using self-balancing, your next deposit would go primarily into Coca-Cola to restore the balance. This is a pretty good option for your deposits, however there is an issue I'd like to address here. If I were copying a Pi, I would start off with doing self-balancing early on while your portfolio is still being built up, and the deposits you have a bigger impact on the overall allocation. However, once your portfolio gets to a certain size, the additional deposits don't make a big enough difference to balance out the portfolio. For example, if you start with £400 and add £100 a month, that first deposit you're adding is a 25% increase in your overall portfolio size just in the first month. But after a few years and your portfolio has grown to £4,000, those £100 monthly deposits only account for 2.5% of your overall portfolio now, and it's less likely to be able to balance anything. At that point, it's better to switch targets and manually rebalance sporadically. The next option is buy targets. The buy targets option allows you to distribute your funds strictly according to the percentages you've set for your portfolio. Unlike self-balancing, it doesn't adjust for any changes caused by market fluctuations. Instead, it ensures every deposit adheres to your original target allocation. For instance, if we go back to our Apple Cola portfolio of 50-50, every new deposit will follow these exact proportions. This option doesn't consider whether certain investments have grown or shrunk in size, this simply follows the plan you've established. Buy targets is ideal for investors who have a clear long-term strategy and want to stick to it with precision. It provides discipline and consistency, making it a great choice for those who prefer full control over how their money is allocated. It may require manual rebalancing later on though. Also worth noting that if you're auto-investing, then it'll choose by targets to make the deposits. Now on Trading 212, it's important to bear in mind that Pi's and the auto-invest feature is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits, and you're responsible for all investment and rebalancing decisions. And if you're watching this video as you're new to Trading 212, don't miss out on the sign-up offer for new users. I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section. Capital at risk, terms apply. If you've opened up a new account recently or are planning to open an account, and then here it is, DivExp or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive free fractional shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support, and thanks to Trading 212 for sponsoring this video. Now finally, the last option, custom. The custom option gives you complete flexibility over how to allocate a specific deposit. Unlike self-balancing or buy targets, this method allows you to decide how your money is distributed in that moment, without being tied to your portfolio's general rules or targets. This option is particularly useful if you want to take advantage of unique opportunities or address specific investment goals. For example, if you notice that stock prices have dropped significantly, you might choose to allocate 100% of your deposit to stocks to capitalize on the dip. That being said, I don't really see the point in doing that, as you can import stocks into the pie. I don't see a reason to deposit custom into the pie, rather than just buy outside of the pie and then import it in later. The pie allocations you set up were set up for a reason, right? My view is that Trading 212 only even added this as an option to stop the whiners on the margin who would inevitably want the freedom to do it. But anyway, which should you choose? As always, each of these allocation methods serves a different purpose, and the right one for you depends on your investment goals, preferences, and level of experience. If you ask me what I would do, it's this. To begin with, self-balancing is a solid choice because it keeps things simple and doesn't require much effort from you. It's great when you're just getting started or don't want to overthink every deposit. So in short, self-balancing does the job early on. If you go with the buy target option, you'll have to manually rebalance things yourself. As your portfolio grows bigger, self-balancing might not cut it anymore, and you'll probably need to get more hands-on at that stage and switch to targets, then manually rebalance. If you have any other questions on this, or even other Trading 212 features, you're welcome to ask below in the comments here, or in the Discord, the Dividend Temple, where we are a growing community of investors just like you. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!